We all understand the importance of investing as much money as possible to build long-term wealth and ensure we have enough money to support ourselves throughout retirement. However, many of us aren't entirely sure where we stand financially or whether we are truly on track to meet our retirement goals. So in this video, I'm going to talk about 4 signs that you might need to invest more money than you think. I will also be sharing the average investment pot needed for every age group, based on some key data that we'll be looking at shortly, so you can see where you stand. Hopefully, by the end of it, you'll have a solid benchmark of what you should be aiming for. Okay, so according to the latest data from ONS, the average pension pot for individuals aged 55 to 64, the age range when most people begin to retire, is just £96,500. With an average pot of less than £100,000, it's clear that many could face financial challenges in retirement, unless they have additional income streams or substantial savings to fall back on. On the surface, $96,500 might seem like a fair bit, but when you think about it lasting you through 20 to 30 years of retirement, it suddenly doesn't stretch that far. Spread over 30 years, that's only about £3,200 a year, or roughly £270 a month, which isn't nearly enough to live on, especially with rising costs. Now, this was the average pension pot, but it doesn't mean much unless we compare it to something. So we need to come up with a target of how much we'll actually need in retirement to cover all of the things that we want. So how much money do you actually need in retirement? Well, according to the latest research by Which, we need about £14,400 per year to have a minimum or basic lifestyle in retirement. This means having enough money to cover the essentials, such as groceries, transport, utility bills, and so on. For a more moderate lifestyle, which includes all the basics, but also regular short-haul holidays, recreation and leisure, charity giving, and so on, you would need £31,300 per year in retirement. And lastly, for a comfortable lifestyle, you would need £43,100 per year. This includes both essential and comfortable lifestyle costs, but it also means having enough money to go on long holidays, buy a health club membership, eat out at expensive restaurants, and so on. I will assume that after a life of working hard, most of us will want to have a comfortable lifestyle in retirement. So according to this study, to maintain a comfortable lifestyle in retirement for 25 years, you would need a retirement pot of approximately £1,077,500. However, there is a huge problem with this target, and something that most people tend to ignore when they plan for retirement. So stick with me and hopefully it will make sense in the end. Now, most of us probably aren't on track to reach this high milestone. And this target in itself should be the first sign that we should probably invest more money. But here are 4 more signs that you might need to invest more money than you think. First off, your current investment portfolio might actually holding you back. Not because you're doing anything wrong, but because it could be too conservative for your age or goals. And that's something that a lot of people don't realize. For example, let's say you're in your 30s or 40s and you've got a 60-40 portfolio, meaning 60% in stocks and 40% in bonds. If you're planning to invest for the next 20 or 30 years, that kind of allocation could mean missing out on a lot of long-term growth. Because the longer your money sits in low-risk, low-return assets, the more you fall behind. Not just due to inflation, but also the compounding returns you're giving up. Just to put some numbers on it, if you invest £300 a month for 30 years and earn 6% a year, you'd end up with about £300,000. But if you earn 9% a year instead, that jumps to roughly £549,000. Same amount invested, same time period, but a difference of nearly £250,000. That's the power of compounding. Now look, being cautious isn't always a bad thing. A more conservative portfolio can help you sleep better at night, especially if you know that you would panic and sell when the market dips. That emotional risk matters. But here's the thing, being conservative isn't just about risk tolerance. Sometimes it's driven by fear or uncertainty, or just not having a clear plan. And that's where it can quietly hold you back. So instead of asking what feels safe right now, a better question is, what do I need my money to do for me over the next 10, 20, or even 30 years? If your answer is anything like I want to retire comfortably, or buy a home, or build financial freedom, then chances are your money needs to work a bit harder than it is right now. So if you look at your portfolio and realize most of it is sitting in low risk assets just because it feels less stressful, that could be a sign you need to invest more and perhaps invest differently. to give yourself a proper shot at reaching your goals. A conservative portfolio isn't automatically bad, but lower returns mean you'll need to make up for it with higher contributions. If you don't, you could quietly fall behind without even noticing. Another sign you should probably be investing more is if your income has gone up, but your investments haven't. If you've had a raise, switched to a higher paying job, or picked up an extra income stream, brilliant. That's a great step forward. But if the amount you're investing each month hasn't changed at all, you might be falling behind without even realizing it, at least in relative terms. Now, I'm not saying you need to throw every extra pound into the market. It's perfectly reasonable to enjoy a better lifestyle as your income grows. That's part of why we work hard in the first place. But here's the issue. If your spending increases while your investing stays flat, the gap between what you could invest and what you actually invest starts to widen. And over time, that can make a serious difference. Think of it this way. If you were comfortably investing £200 a month when you earned £2,000, let's say, and now you're earning £3,000, but still only putting away the same £200, you're actually investing less as a percentage of your income. And this matters because investing isn't just about hitting a fixed number. It's about keeping pace. As your income grows, ideally your wealth building should scale with it. Otherwise, lifestyle creep quietly eats into your future gains. So if your earnings have gone up but your investments haven't moved, that's a sign to stop and ask, could I comfortably invest a bit more now? And if the answer is yes, even if it's just £50 or £100 more, that adds up massively over time. Another big sign you might need to invest more is if you've never really factored inflation into your long-term plans. It's one of those sneaky things that creeps in quietly, but has a huge impact on what your money will actually be worth and what it can do for you in the future. So remember that £1 million target from which that's how much you will need today to enjoy a comfortable retirement over 25 years. But if you're planning to retire in 30 years, that number isn't nearly enough. Why? Because of inflation. Even at an average inflation rate of just 3% a year, that same £1 million will only have the spending power of about £410,000 by then. In other words, to match today's £1 million in 30 years' time, you would actually need closer to £2.6 million. That's a massive difference. And it shows why adjusting for inflation is crucial when planning your investments. Without it, you risk aiming for a goal that won't stretch nearly as far as you think. Prices don't stay still. Food, energy, housing, they all tend to rise over time. And if your investments aren't keeping up, you're losing ground by default. If you're still contributing the same amount you set up 5 or 10 years ago, there is a real chance it's no longer enough. The bottom line is this: if the cost of living is rising, your investment contributions likely need to rise as well. Not to get ahead, but simply to keep pace. And the longer you delay that adjustment, the steeper the climb becomes later on. Finally, the last sign that you might need to invest more money than you think is if you've got overly optimistic expectations about future stock market returns. Let me give you some context. In 2023, Schroders surveyed over 23,000 investors from all over the world to find out what they expected from their investments in the long run. On average, people said they were expecting returns of almost 11.5% per year above inflation, not just 11.5% total. That's real returns after inflation. Now, to put that into perspective, the MSCI World Index, which tracks global stocks, has returned about 8.16% per year over the last 40 years. And Schroders' own forecast for the next decade is a more modest 7% per year. What this tells us is that after more than a decade of strong market performance, many investors have grown used to the idea of consistently high returns. Now, there is nothing wrong with being hopeful. But if you're planning your financial future on the assumption that markets will always outperform, you could end up underinvesting. The truth is, markets don't move in straight lines, and relying on double-digit gains year after year can set you up for disappointment. And if you're also overlooking inflation, as we talked about earlier, that compounds the risk even further. So the bottom line is that if your long-term plan assumes returns that are higher than historical averages, that's a strong sign you should be investing more to build a safety margin. Because the returns you actually get might be much more modest than you're expecting. Now, you might be thinking, okay, I get it, I probably need to invest more. But how much more exactly? Let's break it down with an example. If we assume an average return of 8% per year and use our inflation adjusted target of £2.6 million, the future equivalent of £1 million in today's money, here is roughly how much you need to invest as a lump sum at different ages to reach that goal by age 65. Assuming no further contributions. At age 25, you need to have around £110,000 invested. At 35, that figure jumps to roughly £245,000. By 45, you're looking at about £550,000. And at 55, you'll need around £1.2 million invested to hit that same target by 65. Of course, most of us aren't investing large lump sums all at once. And it's also worth remembering that you likely have a workplace pension and potentially some state pension income to draw from in retirement. So this isn't about hitting that £2.6 million target purely through personal investing. But it does help frame just how much effort it can take to reach true financial independence if your goals are ambitious. Another thing to keep in mind is that your spending needs won't stay the same throughout retirement. You'll likely be more active in your 60s and maybe into your mid-70s, traveling more, going out and spending on experiences. But after that, most people tend to slow down, take fewer holidays, buy less stuff, and live a more sedentary lifestyle. So realistically, you probably won't need the same level of income in your late 70s and 80s as you did in the earlier stages of retirement, which can take some pressure off that big headline number you're aiming for. Also, these calculations are based on the idea of wanting a comfortable lifestyle, but some people might prefer a more moderate one, which means your investment target will change. So the key is to plan with a bit of flexibility and common sense, rather than stressing over unrealistic targets. Now, with all this said, the goal isn't to always invest more and constantly think about the future. Life isn't just about planning ahead. It's also about living in the present. Yes, it's important to be prepared for the years ahead, but it's also important to enjoy your life right now. That could mean taking holidays, spending time with people you care about, or just having a bit of fun with your money. So this isn't about making you feel guilty or saying you're not doing enough. It's just about being aware. Sometimes we don't realize that our habits haven't kept up with our goals or our income. And it's worth checking in on that. Because the real goal isn't to live only for tomorrow. It's to build a future without missing out on today. That's where balance comes in. Some months you might be in a good position to invest more. Other months you might want to enjoy what you've earned, and that's completely fine, as long as you're being honest with yourself and making choices that match what you actually want in the long term. In fact, to give you a bit of reassurance, take a look at this. Out of the entire adult population in the UK, only around 11 million people have any kind of ISA, and that includes basic cash ISAs, not just investment accounts. When we look specifically at stocks and shares ISAs, the number is even smaller. Fewer than 4 million people currently hold one, which means less than 15% of UK adults are actually investing through them. So if you're watching this video, chances are you're already taking your finances more seriously than most. And you're probably one of the relatively few people investing for the long term. Now, if you're unsure whether you're investing in the right things, check out this video next, where I walk through 6 ETFs that every UK investor should probably consider. See you there.